In 2023, Tim Cook's official salary at Apple was $3 million. That's the number that ends up in headlines, in documentaries, in outrage threads about wealth inequality. And for most of the planet, $3 million is an obscene amount of money. It's also almost completely beside the point. His actual compensation that year was $63.2 million. The other $60 million wasn't a surprise bonus, wasn't a lucky bet, wasn't a typo nobody caught. The $3 million salary exists mostly so journalists have a number they can print without starting a small riot. This video is about the other $60 million, and about why almost every CEO on the planet gets paid through the exact same structure, buried inside a document nobody opens unless they're being paid to. That structure has an official name: total compensation. It sounds like a phrase an HR department invented to make a spreadsheet feel important, and yet the concept genuinely matters. When a board hires a CEO, it isn't filling a vacancy. It's drafting a multi-year financial arrangement built to align incentives and make quitting feel about as appealing as setting your own house on fire. Salary sits on top of that arrangement, fully visible, and almost always the smallest piece of it. Underneath, equity, long-term incentives, perks, deferred pay, all disclosed publicly in a filing called the proxy statement. None of it is hidden, it's just formatted in a way that discourages anyone from actually reading it. So let's read it, layer by layer. Layer 1 is equity, and it behaves nothing like a paycheck. A board might approve $5 million in stock for the year, but that stock doesn't land in an account on Friday. It vests, released gradually over 3 to 5 years, often only if the company hits specific targets first, which means an executive's personal wealth ends up tied to decisions they haven't made yet. Every earnings call, every strategic bet, every extra quarter in the chair moves their net worth in real time. A remarkably effective way to make someone care about a stock price, arguably more effective than any motivational poster in the break room. Leave too early, and whatever hasn't vested simply disappears. The industry has a name for that too: golden handcuffs. A polite way of saying the deal is built, so the cost of quitting outweighs almost any offer a headhunter could make over lunch. The extreme version of this logic is Elon Musk's original Tesla package, a $1 base salary and an entire compensation plan riding on stock options tied to market cap and operational targets that most analysts at the time considered somewhere between ambitious and delusional. Tesla hit every single one. The package became one of the largest compensation events in corporate history: $1 in salary, tens of billions in outcome. The salary was never the point, it was the rounding error. Layer 2 tends to make people laugh and get quietly furious in the same breath. Perquisites. The SEC requires companies to disclose any executive perk worth more than $10,000 a year, and what actually gets disclosed is a genre of its own. Private aircraft is the standard. Research firm Equilar found that more than 60% of S&P 500 CEOs have access to a company jet, and in many contracts, personal use isn't a workaround. It's written in as a benefit. When Delta's former CEO retired, his package included lifetime first-class flights for himself and his family. Run the math on what a lifetime of first-class tickets actually costs, and the number gets uncomfortable fast. Delta presumably ran that math first and signed anyway. Security is the fastest growing category right now. After United Health's CEO was killed in late 2024, boards moved quickly. Protection teams, residential security, armored transport. Among S&P 500 companies, the share of CEOs with a formal security perk jumped from 18 to nearly 25% in a single year. In the S&P 100, 59% now have one. Everything else, tax advisors, estate attorneys, club memberships, hospital networks that have never once appeared on your insurance card, sits quietly underneath, filed, searchable, and almost never read. Layer 3 is the bonus, except there are two of them running at the same time because apparently one wasn't enough. The short-term incentive is the annual cash bonus, tied to that year's numbers: revenue, margin, market share. For the median S&P 500 CEO, the target sits between 1 and 1.5 times base salary, and in a strong year, boards routinely approve double that. The long-term incentive pays out over 3 to 5 years, measured against how the company performed relative to its peers, not simply whether the market went up. The point is to reward beating the industry, not surviving inside a bull market. Put it together, and in a good year, a CEO collects base salary, a maxed out annual bonus, a long-term award finally maturing, and a rising equity stake, all at once. 4 income streams landing in the same 12 months, each one negotiated years in advance. That isn't a lucky year. That's the spreadsheet working exactly as designed. Then there's the exit, which tends to raise the most eyebrows. When a CEO leaves, through termination, a merger, or a board-engineered retirement, a clause called the golden parachute activates, guaranteeing a payout regardless of why they're walking out the door. The board's logic is reasonable on paper. An executive personally afraid of losing their job shouldn't be the one deciding whether to approve a sale that's good for shareholders. Remove the fear and they make the right call. In practice, the clause doesn't ask many questions. Fired for poor performance, pushed out, company sold, the parachute opens the same way every time, and the career rarely actually ends. Board seats, advisory roles, consulting contracts, often with the very company they just left, keep the equity, the network, and the income running long after the title is gone. For a Fortune 500 CEO, retirement isn't really an ending, it just changes costume, which, to be fair, is a genuinely excellent deal, assuming you can get anywhere near the door in the first place. None of this is hidden. It's legal, disclosed, and signed off by boards who know exactly what they're approving. Sitting inside public filings, the SEC requires every company to publish. The only thing standing between you and all of it is a few hundred pages of formatting specifically designed to discourage curiosity. And that gap matters because the way a CEO gets paid quietly shapes the decisions they make, which deals get approved, how long they stay, what risks they're willing to take, and exactly when it becomes worth it to walk away. The pay package isn't just a reward. It's an instruction manual written in a language most people were never taught to read. If unpacking how the corporate world actually runs is useful to you, the subscribe button is right there. And if there's a specific company or industry whose numbers you want pulled apart next, that's exactly what the comments are for.